In this video, we are looking at what I believe to be the most undervalued European company that you need to consider for your portfolio. When we run through these financial metrics, you are going to be positively surprised and question why this hasn't already crossed your radar. So today's episode, we have a lot to get through. We are looking at Evolution AB. Now, they engage in the development, production, marketing, and licensing of live game shows and casinos. And there is a lot to love about this company. Now, we're going to look at their historical performance. As always, we are going to look at their income statement, their phenomenal growth, their bottom line and top line growth over the last 5 years. We're going to look at their balance sheet. This is an incredible company. We're going to take a look at their health, total cash, total debt. We're also going to compare how they've performed on a total return basis versus their competitors in the industry. And we are going to take a look at what their mission is, who they are exactly, and some incredible points from their latest Q3 investor presentation. And as always, we are going to look at some incredible financial metrics that you need to see before considering investing in Evolution. And as always, we will run them through our stock valuation, getting to our intrinsic value, our acceptable buy price given our margin of safety. Now, let's start off by saying that year to date, they are down around 12%. We can see currently on the day they are up 2.89%, and they are towards their 52-week low. Now, this company does positively offer a yield of 2.45%, and investors who have been holding this company over the last 5 years would be up a significant 514%. Now, we can see this stock did essentially peak at around $200, so more than double the current trading price, and the market cap is only $18.9 billion. So the question in today's episode is, how cheap is this company? How good is it? Is it as good as it looks on the financials? We're going to dig deeper and we're going to understand, should this be added in your portfolio ASAP? Now, remember to always do your own due diligence. So let's start off with their income statement, their top line growth, and what we like to see is 3 to 7% growth year on year. Well, forget that. This company is phenomenal. December 2018, 281 million on that top line. 5 years later, December 22, 1.56 billion. So that is some phenomenal increase over the last 5 years. On top of that, that growth over the period has been incredible to see. And we are going to touch upon the last 10 years percentage-wise too. So some incredible growth, more than 5 times, in fact, over the last 5 years. How does that compare to the bottom line net income? Well, 96 million reported in net income in 2018. Latest report, December 22, 903 million. This is incredible. 10 times their bottom line over the last 5 years. And on top of that, we can see them increasing year on year. So far, we have a great essential income statement that we have just briefly gone through. Now, how is their balance sheet? Very quickly looking at their total cash versus total debt. Well, what we see, total cash and short-term investments, 97 million in December 2018. Latest quarterly report, 860 million. So they are sitting on quite a significant amount of cash than they did 5 years ago, nearly 10 times as much. How does that 860 million compare to their total debt numerically and directionally over the last 5 years? Well, they had around 7.5 million debt in 2018, total debt as well. Latest quarterly report, 85 million. They have a far sufficient essential total cash balance to pay off all of that debt if needed at any moment in time. That is phenomenal to see and very positive so far. Now, in terms of their peers, we have DraftKings and a few hotels and casinos in the gaming industry. So let's take a look year-to-date total return. Well, we can see Evo Gaming down around 7.5%. Very poor, in fact, year-to-date. In fact, one of the worst, if not the worst, out of their competitors. And if we take a broader look at the last 5 years, so including those dividends repaid as a total return, what we can see for Evolution Gaming, up 549%, far outperforming any of them in their peers. If we take a look at DKNG, we can see DraftKings the second best, but significantly underperforming Evolution Gaming. Remember though, we always take this with a pinch of salt. We don't look at historic data and use it as an indicator for the future, but it is always good to see just so we can see how they have performed in the past. Now, very quickly, what are their missions and value? Well, their vision is to be the world-leading provider of online casinos, which we'll take a look at shortly in terms of their geographical locations. and their mission is to make operators successful and provide an excellent user experience for their end users. So very quickly at their latest presentation from Q3, what we can see their geographic breakdown, so all the companies, or essentially all of the regions they're in, Europe, Asia, North America, Latin America, and other. The main thing to take away from here, every single quarter we can see quarter-on-quarter growth, which is very positive to see. And on top of that, for the large part in all of the regions that we see, there has been quite a significant growth quarter-on-quarter as well. Some places you can see that they haven't grown every single quarter. But over the whole, we can see, in fact, on the total operating income year over year, quarter over quarter, that revenue is rising, as we saw when we took a look at their income statement. The other thing to note here, as we can see, they have a share of around 40% of the regulated market as well. And for those that prefer to see the information in a graph, what this essentially depicts is the blue graph is that revenue quarter on quarter increasing very positively. And not only is that revenue increasing, but their EBITDA that we can see here in the gray, which is the earnings before interest, tax, depreciation, amortization, is also increasing quarter on quarter in line with the revenue. And for those who want to see the EBITDA percentage from, well, essentially 55.7% all the way to 70.4%. So not only is their revenue increasing as well as that EBITDA, but their EBITDA percentage is also going in the right direction. So far there is a lot to love about Evolution. And now let's take a look at some financial metrics. Now it is trading around $90 with a yield of just over 2%. And as we mentioned earlier, that market cap sitting around 19 billion, making a large cap company. Now, dividend growth, phenomenal to see. 41% over the last full year, 62% compounded on average year on year, and 73% over the last 10 years. Now, over the last 10 years, not only is your dividend increasing 73% year on year, but when we take a look, you're also essentially getting more than 514% growth over that period. So name me any company in your portfolio or that you know that has this phenomenal share price appreciation as well as this dividend growth. But do be aware as well, 2014, they did in fact cut their dividend, as we see here, to 2015 before increasing. So a few bits there just to understand. Now, earnings versus free cash flow. As always, earnings susceptible to manipulation by management through accounting. So we focus on that free cash flow. Below 60% personally is what I like to see. Every investor is different because in my opinion, it means management have that ability to offer those double-digit increases. And over the major part of the last 10 years, it has been in fact below that 60%. The last few years in the 50s, with 2023 expected 40%. So for me, this is positive. I do see that dividend as safe, and those increases will hopefully keep coming. Earnings per share, again, data available there for investors. Let's draw your attention to the free cash flow. 2 cents in 2013, 3.66 in 2022, 2023 expected 5.16. There isn't really much to say here other than this is some phenomenal growth. If it continues, I would really struggle to find any other potential company that could outperform this over the next 10 years. Sales growth, double digit every single year over the last 10 years, 90% in 2021, 36% in 2022. It's gone from revenue in 2013 of 40 million to 1.46 billion over that 10-year period. Phenomenal growth. Again, this really could be a multi-bagger in your portfolio. Now, shares outstanding, we can see they have issued shares over the last 10 years, but it has gone from 175 million to 218. So you may argue it isn't that much, but do remember when companies do issue shares, it does dilute your position as a shareholder. ROIC, again, a regular theme, 10% or more is what we aim for on the channel because management are then able to effectively allocate their capital based on that, in my opinion. And what we can see for the large part has been well above 10% every single year. Yes, we have a very strong period from 2013 to 2019 of around 50%. But even over the last few years, we do see here still strong in the 20s. So I would say this is very positive. And if this does continue, this could be a phenomenal company. Operating margin, free cash flow margin, whilst it's even above the minimum on 16% on the operating margin and 7% on the free cash flow margin. What else is positive to see is that it is continuing to increase as well as that EBITDA that we did run through earlier on. Even the EBITDA percentage increasing from 55.7 to 70.4. And now we're also seeing an increase on that free cash flow margin as well. So lots of positives to take from this company. And as we ran through in that balance sheet review, the net debt to earnings before interest, tax, depreciation, and amortization, showing us that it wouldn't even take them 1 day or 0.01 day to pay off all of their debt if needed. So much positive from this company, but what about the valuation? We're going to run it through our valuation model, and as always, do hit that like button, do subscribe and hit the bell if you want to be continually notified of these videos. And as always, if you want to grab a copy of the intrinsic value calculator to get to acceptable buy price of companies in your own portfolio, then do click on the pinned comment below. Now, jumping into Graham's valuation, we have the stock ticker symbol here for USD, the earnings per share, growth rate per analyst estimates, and that current yield on AAA corporate bonds. Remember that current yield, as it goes higher, the intrinsic value goes lower. This gives an intrinsic value of $94, which is slightly higher than the current trading price, but not that far off, signaling it could be some fair valuation based on today's price. But remember, we don't look at any model in isolation and we'll draw our conclusions towards the end of the episode. Now, we move on to the second model, which would typically be the multiples valuation with companies in the similar sector and size that we ran through. But given the fact that DraftKings and Flutter Entertainment have negative earnings per share, it will be difficult to use this valuation model. Therefore, we will be excluding it into our final calculation. But typically, we'd have their stock price, earnings per share, get their PE multiples, get the average, and multiply that by the earnings per share to get to our multiples valuation stock price. So moving on to the second model we're using is that dividend discount model, where the average growth over the period is around 64%. Now that is a phenomenal increase over that period. Forward looking, I have gone slightly more conservative at 6.5%, but you know the drill. If you do want to play around with the percentage, get it higher or lower depending on your own investment thesis, then do grab a copy of the model and play around with that. However, based on this, the DDM price is coming to $142. As we can see, slightly higher than the 52-week high, showing strong signs of undervaluation, severe undervaluation in the current market. We then move on to the discounted cash flow model, where we have our free cash flows over the period. Average growth rate, very strong, just under 80%. Forward looking, analysts estimating between 18 to 20, so I've gone more conservative. With our discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, arrive at that equity value, divide by the shares outstanding to give a DCF price of $150. Again, slightly higher than that 52-week high, showing signs of more than 50% upside to that current price. And do bear in mind, you are also locking in that yield, with your yield on cost going higher and higher as over time. Now, when we take a look at the intrinsic value, it is essentially the average of those three models that we've just run through. And again, if you do enjoy the content, value is being provided. Hit that like button, subscribe, hit the bell to be continually notified of these videos. Now, margin of safety, you could argue 10% if you believe it has a wide moat, strong financial metrics, good forward-looking data. Now, I would say you should go a bit higher with this company in general, whether or not you can argue it has a wide moat and it has good, strong financial metrics. Personally, I think it does, as we ran through, but every investor has different thesis. Now, 15% margin of safety, it is a buy up to $109, 20% margin of safety up to $103, and 25% margin of safety up to $96. Now, there are people there who will be saying they want a higher margin of safety, and that is completely okay, depending on their strategy. So a 30% margin of safety is effectively locking in a price of around $90. Now, we can see it has gone slightly higher than that, around 91. So even at 91, you could argue you're getting a rough 30% margin of safety. Now, Wall Street have forecasted the price to have even more upside to $156, so they do see this as incredibly undervalued. But remember, as always, do your own due diligence and never rely on whether it's these videos or whether it's on Wall Street. Do your own due diligence. But based on this, do let me know your thoughts in the comments below. Is Evolution one you're looking to add to the portfolio, looking to sell? Your reasons for or against this company if you have a bullish or bearish scenario, or even if you're just on the sidelines speculating. And also let me know if you're enjoying these European stock analysis and want more of them. Don't forget, if you want to grab a copy of the intrinsic value calculation to run your own companies, get your own acceptable buy price and margin of safety, do click on the pinned comment below. Personally, this is one I will be adding to the portfolio. I think it is undervalued right now, and with a 30% margin of safety, even if the price goes lower, I will continue to dollar cost average in for the future, as we saw their phenomenal growth in that investor presentation, as well as when we ran through the financial statements, and they have a more than sufficient cash balance to pay off their total debt when needed. Finally, if you want to join us in the Discord where we're talking about all buys and sells in the market or anything stock market and finance related, do click on that Patreon link below. As always, hit that like button if you've enjoyed today's episode and content's been valuable. Don't forget to subscribe and hit the bell button to have these drop to your doorstep. And as always, have a great day and catch you on the next episode. Take care.